I will say it's about the most challenging time to talk about the market and economy I can remember since I got in the business. I actually believe we are in the most unique set of economic circumstances that I've seen in my career, and certainly in the post-war period. I believe policymakers are failing to acknowledge how unique this period is. And I think the consequences of that could be with us for years, if not decades to come. Now, why do I say the period is so unique? Well, first of all, the COVID-induced decline that we experienced last spring was both violent and abrupt. To put it into math terms, we had 5 times the decline in the average recession in 25% of the time. Think about that. So 5 times the average World War II recession decline in 25% of the time. Monetary and fiscal policy's response to that was equally unprecedented. It's not pleasant to remember back last spring, but if you think about that period, I think we were all terrified that we were experiencing a potential black hole, not only in our lives, but in the economy itself, with potentially catastrophic consequences. If you look at the policy response, it was extremely aggressive. Led by the CARES Act, in 3 months, we increased the government deficit more than the last 5 recessions combined. So if you took the Reagan 82 recession, the Saddam Hussein 90 recession, the dot-com recession, the great financial crisis, you added up all those recessions' effect on our budget and the size of the budget deficit combined, they do not equal how much the budget deficit increased in 3 months last spring. The Fed response was equally aggressive and unprecedented. They did more QE in 6 weeks last spring than they did in the entire period from 2009 to 2018, which you'll remember was somewhat unprecedented in and of itself. And a lot of people were questioning the size of that. Well, the peak month during that 9-year period was when Bernanke did 85 billion in QE. We're still buying 120 billion in securities after the 6 weeks that I talked about. The final thing that happened last spring was the Fed crossed a lot of red lines in terms of what they would backstop in terms of corporate debt, also in the municipal market. The results were very emphatic. Corporations increased their debt in a recession. I don't believe it's ever happened before, over $1 trillion in response to the Fed backstopping that debt. Just to put that into perspective, in the great financial crisis, they shrunk their balance sheets 500 billion, which is much more, I'd say, in consistent with historical activity. The good news is this has resulted, I'd say pleasantly, surprisingly, in a very abrupt and strong recovery. In that context, it was a good risk reward to enact policy expecting a deep and protracted recession in the spring of 2020. It worked, it was dynamic, it was bold. However, a lot has changed since then. By the fall, the outlook had already brightened considerably, and policy support continues to accelerate. Fiscal deficits are going to reach 30% of GDP in just under 2 years. Okay. I'm going to share a screen with you. This is a chart of the cumulative fiscal deficit from the start of the recession, of all the recessions that I mentioned earlier since 1980. And you'll see the top 4 lines are the 4 recessions that preceded this one. I'm sorry, the 5 recessions that preceded this one. And the black line is if you added up all those together. Remarkably, the red line is what we're doing in 2020 and 21. Again, the boldness of what they did in the beginning of that chart, when you say the first 5 or 6 or 7 months, makes a lot of sense. But what's very surprising is we're continuing to double down on these policies, even after it's quite apparent you've had a very strong recovery in the economy. The Fed's easy money will also top a similar amount, almost two times all previous Fed incursions into money printing. Now, what we have observed in recent months is the sharpest recovery from any downturn in recent history. Despite losing 11 million net jobs during 2020, personal income grew at the fastest rate it has grown in 20 years. Think about that. While 11 million people were losing their jobs in a year, we ended the year with the strongest growth in personal income in 20 years. The unemployment rate has recovered 70% of the initial hit in just 6 months. It typically takes 25 months for this to happen. Even after the sharp fall, again, 5 times the average recession, we're already back in terms of GDP to pre-COVID levels in just 5 quarters. The average recession takes 7 quarters, but don't forget, we're coming back from a much deeper hole that was 5 times as deep as that observed in the average recession. It is unnecessary and frankly reckless that 575 billion of the 850 billion in direct transfers of 2.5 trillion of expected QE are being provided after retail sales were above pre-COVID trends and after vaccine confirmation. So if you look at the red line on the chart I have up, that is 2020. I think we can all agree it doesn't look anything like the other recessions, which are more traditional in nature. Much more violent increase in unemployment, and then a huge snapback in a much shorter period of time. I think even moderate voices will agree that the level of support has been excessive. Let me show you how excessive it actually has been. This is a chart of retail sales the last 20 years. They are currently above pre-COVID trend by 15%. Look at the period from 2008 to 2014. It took 6 years to get retail sales back on trend after the great financial crisis. But if you look at the current period, we had a sharp V bottom out, and I mentioned the CARES Act. That's check one. Then we had more fiscal stimulus last fall after vaccines were apparent and after it was apparent that we were in a very unusual recovery. And now, as you know, we've just passed another $1.5 trillion of stimulus when retail sales are 15% above trend. What does that mean exactly? If you took the increase in retail sales from 2016 to 2020 on this chart, that's 3% a year in a recovery. We've just done that in 6 months. We are absolutely booming. We are above trend by, frankly, 5 years in 6 months. Okay. Now let's talk about the Fed's excessive support. The Fed has constantly reminded us that monetary policy acts with long and variable lags. Why then is the Fed still providing emergency financial conditions when the recovery, as I've shown, is in full acceleration? Why are we buying $40 billion of mortgages a month when we are clearly running out of housing supply? Not only is the Fed still providing record amounts of accommodation, it is promising not to raise rates until after 2023, even when the recession is already over. If the Fed raised rates in the first quarter of 2024, as indicated, It will be 41 months after recovering 70% of the drawdown in unemployment. That was the chart I showed with the red line earlier. What do you think the average number of months before the Fed's first hike after a 70% employment recovery is in the post-war period? So it's 41 months that Chairman Powell is predicting. What do you think the average after that kind of recovery has been since World War II? 4 months. 4. And according to the chair, they are not even thinking about ending $120 billion a month of bond purchases. Simply put, the fastest and strongest recovery from any post-war recession is being met with the Fed's easiest response on record, by a mile. Policymakers say we need to go big to avoid downside risks and avoid the stagnation experienced after the great financial crisis. But as I have shown, comparisons with the great financial crisis are completely inappropriate. What about the risks of financial stability? The worst economic periods of the last century have followed the bursting of asset bubbles. Think the 30s after the 29 bubble burst, and think about the great financial crisis after the housing bubble burst. With Dogecoin, which was started as a joke, with a $60 billion market cap and NFTs on everything you can spell out there, is there any doubt in anybody's mind that we're in a bubble? Not to mention stock market to GDP is well above any level that we've seen in the past century.